Securing access to the last remaining berth in the world's largest bulk export port, you just can't underestimate the incredible advantage that will bring to MRL. The Roy Hill and Hancock joint venture that we've signed is another amazing project. We're going to run up someone's private railway line, we're going to put our own train sets on their railway line, we're going to share infrastructure at the mine site, and we're certainly going to share the port. It's just so unique. It's a great cost-effective solution for us to develop our Pilbara assets. It's longevity, security. We're going to be there for more than 30 years, and we can operate through any cycles.
Mineral Resources have come to us and shown respect. The partnership between Mineral Resources and Dallangey provides long-term opportunities and meaningful outcomes. We're very excited about the opportunities that are being given to us. It's a very different approach that Mineral Resources has taken, one that we're not used to seeing with other mining companies. They've got the right way of interacting. It's a two-way communication.
The Ashburton Project is an amazing project. It's 150 kilometres from the coastline. It's hundreds of millions of tonnes of iron ore locked up and stranded. This will allow us to access that using a whole lot of new innovation that's never been seen before. Well, the most exciting thing for me was the fact there's nothing there. You know, we're starting from a clean slate. We're going to build some amazing infrastructure inland. We're going to have this amazing ore road. The port facilities are going to be unique as well. And onto the transhippers, you know, they're the first of their kind. The autonomous road trains are the first of their kind. The crushing plant is the first of its kind. It's our innovation that means we're able to operate through any down cycles.
Lithium is the new gold rush. With Wodgina restarting and Mount Marion thriving, we've got two of the best hard rock lithium deposits in the world. I'll certainly see out my lifetime. The whole world is trying to achieve net zero and decarbonise as quickly as possible. And we have what they need to achieve it. MRL will have the first lithium hydroxide plant in Australia, owning the whole supply chain from digging it up from the ground, literally from pick to product, is unrivaled. The world will know we're a key lithium producer, and they'll know that we're one of the best.
With our sustainable approach and our foothold in the spodumene and lithium hydroxide market, we're poised to play a meaningful role in decarbonisation and electrification. Safe, sustainable, innovative, agile. MinRes is achieving what most businesses aspire to achieve.
MRL's response to COVID just showcases the agility and the speed with which this business can operate. There is no doubt that the WA mining industry would not have been able to continue to function as it did if it hadn't been for the vision and speed at which MRL's team was able to act.
We're an exceptional business by any measure, with a strong pipeline of highly exciting projects and a balance sheet as strong as we have. We're in a very privileged position to be able to deliver.
Good morning. Thanks for joining. This is the Mineral Resources half-year results, so if that's what you're looking for, you're tuned into the right place. I'm Chris Allison. I'm going to be joined shortly by our CFO, Mark Wilson. We put the video on just to try and give you a little bit of a visual of the size of our operations, the size of the equipment, and trying to give you a little more context in what we go through, and I think as I'm talking you might be able to relate back to some of that. Been a tough first half for us financially. The other side, it's probably been the most the most successful half the business has ever seen in terms of business development and locking in the future. I've got quite a bit of detail to go through with you on that down the track. We've locked in 2 major iron ore developments. Stage 1 of both those will give us about 50 million tonnes of run rate. We've renegotiated pretty much all of the lithium business with our JV partners. We've locked in mining services contracts. We're looking at double-digit growth over the next 5 years with our services part of the business. We've had a significant gas discovery up in the Perth Basin, and we've done all that while COVID's been continuing to disrupt supply and push costs up and keep our borders closed and keep the labour supply at the lowest it's ever been. But COVID's probably coming to WA. We're as prepared for it as we can be, and I think over the last 2 years, MinRes has been well ahead of the game compared to others. We've been kind of leading innovation around how to look after our people and keep them safe through COVID. We're continuing to do that. More recently, we've been able to make sure that we know if any of our people have been in contact with others. If we have an outbreak, we can very quickly and efficiently control it. So I'm going to run you through today on the past 6 months' performance. That'll be quite brief. Had we made more money, I would have extended that. The plans over the next 2 to 5 years, which is really important, and there's a lot of messaging in there for you to pick up on, and at the end we'll answer some questions. So highlights in the first half, give you a rundown there on the underlying EBITDA and the cash position. We've kept the operations COVID-free, which is good. All our sites are operating. And everyone's safe. Safety performance in MinRes is simply best in class. Financial results, as you can well see, they're substantially down on last year, but we had the worst iron ore crash in history in terms of the pricing. We've had substantial cost increases, mainly outside the mine gate around energy and shipping, and really volatile and unpredictable conditions. But we've still got return on invested capital of nearly 24%. But as I say, we've been extremely busy securing the next 30 years future for our business, and that's gone exceptionally well. Safety of our people, I mean, as I said, outstanding result considering to the environment we're operating in. Tough conditions out there, very difficult securing people. No lost time injuries, and our TRIFR is down around about 2.25, which is outstanding for a mining and mining services business when you consider how many people we've got out in the field in a very dangerous environment. The results are primarily underpinned by the training that we do in-house. It's substantial, it's intense, we do a lot of it, but that training gives people the awareness we need to keep them safe. We've recruited and we continue to recruit a lot of what we call our second-gen people, second generation. So if you've got a son or a daughter, a cousin, or someone that's related to someone that's working in the business, we think that if people have been in the business for a few years, they understand our culture. When they bring their kids in, the kids know the culture, and we've been extremely successful with developing this part of our business. During this year, so far we've trained 197 new entry-level employees, and they're a mixture of graduates of all sorts, engineering and accounting, apprentices, trainees and operators. And we've opened a state-of-the-art simulated training centre which is producing outstanding results for us. We've got a heavy focus on employee retention. We're looking at making sure that we've got a good environment for them to work in, a great environment in terms of platinum-related work environments. We're building out a new office that, thanks to COVID, has been difficult getting it finished, but we hope to be in there in the next few months. Both the mental and physical well-being of our people is a prime focus. It's a daily focus, and we've got people from top to bottom making sure that we have the right environment, the right culture for our people. We're also looking, as I've said earlier, all our new camps going forward are going to be resort-style accommodation, much bigger rooms, better facilities, and able to accommodate couples. and we've just recently introduced an employee share plan, which has been really well received by a lot of our people. Sustainability. The past 2 years the business has grown substantially, but our emissions intensity has reduced by 25%. We are committed to zero emissions. We have a very practical plan in place that we're rolling out continuously. The immediate focus we have is to produce energy from solar wherever we can, and support that with gas-fired. Innovation in the business is also driving lower emissions. We're bringing in equipment that can move more tonnes at lower operating use of fuel, and the larger hubs around Ashburton and the Pilbara hub that I'm going to talk about, the scale of those will reduce the intensity on a per tonne basis, and they'll be powered substantially by solar and again supported by gas. And we are heavily reliant on third parties out there to come along with green energy, and when they do that we'll use whatever becomes available. Okay, operational performance over the last 6 months. Mining services, again, it's been a good story. It continues to grow year on year. We've always had solid growth in the mining services part of our business. Our team are very active in making sure that we're providing a service that's second to none to our customers, and our reputation, our track record and what we do on a daily basis helps us win the future. We're on track for about 15 to 20% growth in this part of our business. The volumes have increased 18% over the last 6 months. EBITDA is up 20%. 4 new contracts added and 3 renewals. The iron ore business, it's been brutal over the last 6 months. We're kind of chasing the price down, managing costs, and looking at turning off any high cost tonnes and dragging out whatever savings we can. Regardless of that, it's the largest price drop in iron ore in history. It literally plummeted $128 a tonne in 67 days. It cost us during this half $631 million in EBITDA. So that's where most of our pain come. In fact, that's where all of it come from. The lithium business is going strongly. Mount Marion, at the moment we've got a high strip ratio in a low yield region of the pit, so production over this half we're moving forward and now likely going to be at the bottom end of guidance. I'll talk a little bit more about that later. Wodgina, good news coming out of that. We're starting train 1 and we're well and truly advanced on that. Down at Kemerton on the hydroxide plant with our joint venture partners Albemarle, who are developing that. Train 1's mechanically complete. They've got some feed going in the plant. We expect first sales coming out of that product. There's some work to do on making sure the product is qualified and it's at spec and tested, but under the circumstance the team down there have performed extremely well. And then train 2 mechanical completion will be about the 3rd quarter of this year, and that'll just follow the same process of feed in and getting the bugs out of it and getting it up to spec. So under the circumstances that's all going pretty well. I'll let Mark come and talk you through the financials, and then I'll come back to you and we'll share the most important part on where the business is heading.
Thanks, Chris, and good morning, everybody. And it's a pleasure to be here with you this morning to take you through the interim results from a financial perspective. Consistent with past practice, I'm going to focus my comments on the underlying performance of the business. Sitting outside of the underlying performance is a post-tax gain of $66 million on our disposal of Pilbara Minerals shares during the half. You can find a full reconciliation of our underlying performance to statutories both in the financial statements themselves in the notes and in the appendix to the presentation. I would characterise the half from a financial perspective as challenging. As Chris said, we've had a significant drop in the iron ore price. In addition to that, our discounts on the product have widened from an average of 11% in the prior corresponding period to 35% in this half. So that combined impact with prices had a major driver on our results. In terms of costs have been under pressure, as Chris said. A significant portion of that pressure has been felt outside the mine gate, and it's important to understand that those cost pressures aren't necessarily being embedded into our cost structure going forward. Generally, the operational performance has been good in the business, the underlying performance, and I think the results show the benefit of the diversification that we have in our business model. In terms of the next slide, the underlying profit and loss statement, sitting in the profit figures for the half, a strong contribution, as Chris said, from the mining services business, delivering over 280 million of EBITDA. Lithium has contributed 61 million off the back of a rebound in pricing, and we expect that to continue going forward. The iron ore business contributed a net EBITDA loss of 104 million. Important to recognise that 43 million of that is referable to the prior period in terms of price adjustments. I want to call out in particular on the cost side, over $200 million increase sitting outside the mine gate or past the mine gate, and that's by reference to the prior corresponding period. But $151 million impact on shipping. We've struggled with shipping in the half. It's been a very, very tight market, particularly for the sorts of vessels that we're chartering. We're already starting to see some of those costs come back, however. In terms of haulage, post-mine gate in particular, $54 million impact against the PCP. That's in large part a function of COVID and the challenges we've had with trying to secure haulage services in Western Australia. Again, I would suggest that those cost increases are not going to be embedded in the business going forward. Given the group's investment program in front of it and given the results, the board determined that there would be no interim dividend paid for the period. The next slide shows the bridge underlying EBITDA on a PCP basis, and you can see on that slide starkly the impact, as Chris said, of the iron ore price decline, 631 million. You can also see the impact very clearly of the shipping. Conversely, on the positive side, you can see the increased contribution from mining services, as well as the improvement in terms of volume production out of the business. So underlying performance remains solid, but hammered by the iron ore price and the costs post-mine gate. In terms of the cash flow slide, historically, as a business, we've delivered 100% profit conversion to cash. That's what we've typically done over time. This period we've seen an impact in terms of predominantly a growth in inventories on the various sites as we've adjusted our approach to respond to the pricing and so on. In the half, we also had some sizable tax and dividend payments that were referable to FY21. And you can see on the cash slide, continued CapEx investment for the future in this period, 403 million. In terms of the CapEx itself, the 400 million largely split between sustaining and growth. Just want to reinforce that from a business perspective, we're absolutely fixed on ensuring that our investment decisions are going to deliver at least 20% return on invested capital after tax. That position hasn't changed, so all the investment we're doing is to support those or that objective. In terms of the balance sheet itself, balance sheet remains very strong. Cash position remains solid, and we're well placed to fund the future growth of the business off the back of our balance sheet. The next 5 years remain very bright, and the future looks very promising as we move forward to unlock the investments that we have in front of us. As we develop that cash flow off the back of those strong returns that we expect out of those projects, we'll be able to continue to pay fully franked dividends going forward. Thank you. With that, I'll now hand back to Chris.
Okay, so let's talk about the future. As I said earlier, this period we've been through over the last 6 months, we've worked extremely hard to secure a range of opportunities. Some of them we've been working on for 7 or 8 years, some of them for 3 or 4, and we managed to pull them all together and sort of get them into a position where they are actually locked in, and we know exactly where we're heading. So this development phase I'm going to talk about over the next 5 years, this is not something that we hope will happen or we're thinking we might win at 10 of these. Are all locked in projects. I mean, the business has changed and evolved an awful lot over the last 5 years. The next 5 years are going to be way more radical. We're going to be able to accelerate what we've been doing. We're going to make a lot of changes. There'll be a bit of news flow this calendar year coming out of the business as we get things lined up and we're in a position where we can talk more about them. But look, in short, in summary, the business, the mining services business, it'll continue to grow at an average of 15 to 20% year on year over the next 5 years. It has a great list of tier 1 customers. It delivers to them. It has a great reputation in the market, and it also has as good a list of tier 1 JV partners that we're entering into projects where we have the management rights and will be delivering low-cost products for those partners. So in short, the mining services business will more than double over the next 5 years, and that's from projects that we've got locked in now. The iron ore business, so at the moment we're running a high-cost, smaller type pit iron ore operation. The 2 new zones that we've got through Ashburton and the Pilbara hub will allow us to move into a low-cost, long life operation, so 30 plus years in each of those. We're going to start stage 1 on the Ashburton at 30 million tonne a year run rate, looking for first ore in 2 years down the track, 20 million tonnes coming out of the Pilbara hub. These operations are going to be sustainable through any of the low iron ore prices that we've seen over the last 20 years. The lithium, we've probably got, without doubt, 2 of the best hard rock deposits. They are actually tier 1 mines, and they're owned with 2 extremely good joint venture partners. They're in WA, so we're in probably the most socially acceptable mining jurisdiction in the world, and probably the best, the safest. We've got a secure government. We're in a great location, and the weather's manageable most of the time. As MinRes, we're targeting over 100,000 tonnes of lithium hydroxide production within about 5 years. And we've got locked in capability in terms of our joint venture partners are probably the 2 best hydroxide producers in the world. So we're in good company with our mining services, with our iron ore, with our lithium business. We've got great partners. And then the gas business, as luck would have it, we put our first drill rod down up in the Perth Basin, and we hit a fairly major discovery up there in September, October. We're looking basically in there to secure long life, low cost energy. That can be the basis of a range of different opportunities that we have going forward if we know that we've got that low cost locked in for 20, 30 or 40 years. And we'll be able to use the gas initially for our own operations, JV partners, clients, and areas where we get benefit. And we've got a fairly extensive exploration programmed over the next 2 years. So I'll get into a bit of detail now on each one of those. But look, in short, in MinRes, we've got tier 1 assets, we've got tier 1 customers and JV partners. We've got growth projects over the next 5 years that are locked in, and we can manage most of that in-house. We have that capability. We have a very, very clear funding plan, and that'll be progressively shared with the market as we start to get to the beginning of the development stage in each one of those. I do hear some noise sometimes about how are we going to fund all this. So over the last 15 or 20 years, we've always had a very clear plan on how we fund our projects. We've had a very firm grip on our balance sheet, and I would say that we're one of the best on the market on return on invested capital. So just to give you the message, it's all well and truly planned on how we're going to fund it, and we're going to continue doing what we've done for the last 20 or 30 years. So nothing's changed, and the recipe will still be the same. So you'll get the returns that we're all used to having. So mining services growth, just a little bit more detail around how that's going to work. The mining services has always been where MinRes started off from, so that's the foundation of this business, the core where our work ethic comes from, our can-do attitude comes from. It gives us the impetus to be able to move when we see opportunity. Generally, out in the industry, to our Tier 1 clients, we're out there, we're delivering crushing, mining, processing and haulage services. We're primarily operating through gold, lithium and iron ore. That's where most of our business happens. And we're pretty focused. I mean, we will take on any mining or hard rock opportunities, but we just seem to find this as our sweet spot. We've got considerable growth opportunities going forward with all of those range of clients that we've got sitting out there. And as I said earlier, that's primarily based on a range of things: delivery, performance, safety, caring about the outcome for our clients, caring about their profitability to make sure that they get what they're looking for, making sure that we deliver and there are never any contractual issues between us and our clients. We are just there to get the job done for them, and we know what we're doing. I can see a consistent 10 to 15% growth in that area of the mining services business over at least the next 3 years. And then when we move into the mining services part of the service we'll be providing to joint venture partners, so in the Ashburton, we'll have 3 build, own, operate contracts up there, substantial contracts, a lot of capital to set them up. So we'll be doing the crushing, 30 million tonnes of our next Gen 2 crushing plants, 30 million tonnes of haulage down about 150 k's of highway. It'll be a privately owned haul road. It'll only be the big girls on it. They'll be hauling 320 tonne of payload. That's an innovation developed in-house with the help of Kenworth. They're the only ones in the world like it. We've got about 17 or 18 of them running in the Yulgan, so we know exactly what they can do. 30 million tonnes of ship loading contracts, so that means that we're going to have 4 transshippers up there, and they're going to be hauling 20,000 tonnes per transshipper about 22 miles out and putting them on Cape-sized carriers. So ironically, after we do all of that, this is going to be our lowest cost port on the west coast. So lots and lots of future for the transshipping business, and somewhere that we want to progress and grow. So the Pilbara hub, we've got a life of mine supply chain contract up there. So MinRes Mining Services is responsible for taking the ore on behalf of the joint venture partners from the gate and putting it in a ship in Port Hedland. They're going to do that with a private haul road from Marillana down to the Mulga Downs railhead. Once it's down there, we'll put it into the stockyard, and our joint venture partners in Hancock, Roy Hill will take that joint venture that we've formed, and they'll take our ore down and they'll place it into our ships. And that's, again, it's another great joint venture that we've done with the Hancock prospecting team, and very good friends of MinRes. So the lithium, primarily just on the lithium, we will continue doing what we're doing at Mount Marion on the mining services. That's not going to change a lot, but up in the Pilbara, we're starting up Wodgina again, so we own the big crushing plant up there, and the mining, the catering and airport services. So that's a mining services contract that's just starting back up now. So iron ore growth, the next 5 years, we're developing 2 transformational projects. We've got the Ashburton Hub, that's known as the Red Hill Iron Ore JV. So we acquired the iron ore rights from Red Hill Iron during the course of last year. Since then, we've signed an agreement with the joint venture partners. So the joint venture partners are Aquila, AMCI, POSCO, and the majority shareholder in Aquila is, of course, Baowu, and we have a 15% shareholding in that entity as well. We've also just been, at the end of January, appointed the manager of the Red Hill Iron JV. So we're going to carry that forward and start getting all the prep work done on that. And the MRL board has approved FID subject to the JV partners. They're going through their process to do the same, and we expect that all to happen prior to middle of this calendar year. So as I said earlier, stage 1, 30 million tonne, at least 30-year mine life, and 58% Fe. We'll have a central hub at Cairns Bore, which is 150 k's from the coast, so one of the closest ore bodies to the coast up in the north. It's a 2-year build, and we're aiming to have first ore on ship somewhere between December 23 and March 24, depending on how we go over the next 3 or 4 months with our COVID. And we've done a huge amount of progress over the last 6 months in terms of port access, approvals, design engineering, access roads, camps, airports, all of the touch points we've put an agreement together up there in Onslow with Thalangie. So we're going to do a 30+ year rental arrangement with them on renting some land so we can put our resort on it. So that in turn gives them known income for a long, long time, and they'll be able to use that for their people up there. We're very, very focused on working with all of the traditional landowners and the station owners and making sure that there's shared benefits going to everyone. And we've also ordered the first 2 transhippers, so they're getting built offshore. Iron ore in the Pilbara Hub, it's a 50-50 JV we've got there with Brockman. Everyone's aware of that. We're the joint venture managers. It's about a 30-year mine life, and there's probably another 10 beyond that. It's 60.5% Fe. 2 years of approvals. This one's going to take us a while to get going. And then about 2 years of development behind that. And again, Hancock and Roy Hill are going to be responsible for doing most of that construction work on that supply chain joint venture agreement in terms of rail upgrade and port development. So very experienced team working on that. So the lithium business has changed substantially over the last 6 or so months. It's a big business. It's world class. We're just getting, as you're aware, we're just getting Wodgina going. But we've sat down with Albemarle and we've had a look at how we can get the most out of this joint venture. And we're exploring the opportunity of MinRes moving back to 50-50 ownership at Wodgina, and we'll take up the management there. It was Mineral Resources designed that plant and the infrastructure. We built it, we've operated it, it's our core business, so that's kind of where we belong. We can deliver an extremely good operation to the JV for the next 40-50 years. It's a big ore body. Kemerton remains the same. The hydroxide plant stays 60-40 ownership, and the offshore hydroxide will all those plants will be built to consume all of the Wodgina feed, and we'll continually just grow those out as market demands. But again, on all of the hydroxide, responsibility of Albemarle to manage those, and also they are responsible for all the marketing and all the sales. The feed for the Kemerton plant, all of that, it's been agreed with Albemarle. That's all coming out of the Greenbushes mine. So good result with all of that, good for both of us. The Mount Marion operation, we're just taking back our 51% offtake. That's been going to Ganfeng since the mine opened. We're taking that back as of 1st of Feb, but we've also entered into a toll treating agreement with Ganfeng in China, so they're going to treat all of the that spod that's coming out of Mount Marion for us, and that'll be jointly sold into the market, and we're expecting first sales around about May this year. Mount Marion growth, look, we're running at about 450,000 tonnes a year down there. We're going through a pretty average part of the pit at the moment. We have to do it. We've got to get that out, and we're doing a couple of studies down there. One of them is what we call yield enhancement. So we want to change the gradation of the ore and reduce the ultrafines. That's probably going to give us about a 10 or 15% increase in product. And then the second thing we're looking at doing is installing a plant to treat what we call the contact ore. So the contact ore, it's found at the outer perimeter of the ore body where the ore body meets the waste. It has a reasonable amount of basalt in that material. So we're going to put a plant in that's probably capable of about 1 million tonnes a year of feed. But that's subject to test work and us getting the results that we expect we will. We'll keep you informed on that, because if that goes ahead, and most likely will, it's going to increase the product volume substantially. Lithium growth, as I said earlier, we're starting train 1. We're well advanced on that. We're looking to have first product on the ground in April. Train 1 turns out 250,000 tonne of 6% product. Trains 2 and 3 are sitting ready, willing and able to go, and we'll restart them in line with market demand, and it'll take us a little while just to get everything cranked up and to get the downstreaming running, but that'll all happen under a fairly good management team that we've assembled. Kemerton hydroxide, we're expecting train 1. As I said earlier, they're putting some feed into that now. We're expecting first sales late 22. There's some work to do with these hydroxide plants. When you get them going, you've got to get the material running through them. It takes a while to commission them, and then once you do that, you've got to make sure that the customers are happy with the material, so a little bit of time. Train 2 is going pretty well, and mechanical completion 3rd quarter of this year, and it'll just follow the same process as train 1. And offshore hydroxide, that's going to be jointly developed between Albemarle and ourselves, and we'll proportionately fund that 50-50 each, and those plants will consume 100% of the Wodgina spod. So in summary, on the lithium business, our aim is to be up around about 100,000 tonnes of hydroxide production in about 5 years from now. And then finally, the last pillar of our business, the energy side of the business. We're the largest acreage holder in both the onshore Perth Basin and up in the Carnarvon Basin up near Onslow. We recently drilled a hole, we call it Lockyer Deep. We hit substantial gas down there. Testing on the well's been slow. We've got to secure a lot of the specialised test equipment and people from both offshore and interstate, and having the borders shut has made it quite difficult. So we're hoping that test work is going to be well and truly underway in March when we get everything in, and we'll have a better understanding probably around the middle of this year of what we got up there. We'll keep you updated on that. On the exploration front, we're probably going to drill at least 6 wells up in the Perth Basin. The holes up there go down about 4.25 k's, so big drill rig and quite a commitment. We're aiming to bring the Little Red Gully gas plant that we inherited a few years ago back online. We want to put another drill rod down there and bring the gas back into that plant. And up in the Carnarvon Basin, we've got a joint venture up there with Buru Energy, and we're planning to drill a couple of wells up there over the next 12 months. So that's basically the onshore region of where Chevron are, so quite a prospective area. Guidance, an update on the guidance. It's a table that's familiar to all of you. We give you production and tonnes that we expect and unit costs. The tonnes are pretty much the same as the recent guidance that we gave. COVID continues to disrupt our supply chain, and it's making life difficult. It's pushing rates up. It's making it unpredictable. Shipping has been a substantial increase over the last 6 or 9 months, and it's causing us a little bit of pain. But the costs that we can control on the sites, in the mines with our own equipment, are well and truly under control and extremely well managed. So the team have done a great job on that. And the mining services, we're going to sit at the traditional sort of 15 to 20%. We're achieving that, and at least the next 3 years will continue to. Okay, so to sum up, it's been a tough period. I mean, the whole team has been under enormous pressure to keep the operations running, and while we're doing all that, we're renegotiating or we're establishing all these new agreements. We're out trying to get approvals in a whole range of areas, literally thousands of them. So the team have worked hard and done an amazing job. So don't judge us on the last 6 months. It's been tough with the iron ore price. The iron ore price seems to have stabilised somewhat, but we all know how unpredictable it can be. But we have certainly been focused on making sure that we've got projects in hand that we're going to deliver over the next 5 years. They're going to set the business up for 30 or 40 years out. And there's going to be a good mix of diversity in terms of the type of products we're going to be able to deliver. And as we go forward, more opportunities are going to come up. So I think we've got a great business. We've moved up the ranks in the ASX over the last few years, and we'll probably will continue to do so. So the growth that we have, as I said earlier, we have it locked in. We know what we're doing financially. Our track record speaks for itself. We've got plenty of good advice around us. We've got a very tough, robust balance sheet. Our track record on delivery, managing, innovation, and we have the team to deliver. So look, I'll wind it up at that, and if you've got any questions, Mark and I will do our best to answer you.
Thank you. If you wish to ask a question via the phone, you will need to press the star key followed by the number 1 on your telephone keypad. If you wish to ask a question via the webcast, please type your question into the Ask a Question box. As a courtesy to others, please limit yourself to 2 questions at a time, and if you have further questions, you're more than welcome to rejoin the queue to ask further questions. Your first phone question today comes from Jack Gabb with Bank of America. Please go ahead.
Thanks, and good morning all. The first question is just on your capex and balance sheet. I guess you're talking about adding around about 80,000 tonnes of attributable hydroxide capacity and a further 10% stake in Wodgina. And I guess even if Albemarle agrees to sell down at cost, and I guess I'm a bit unsure why they would, that's over $1 billion outlay. Then you've got 2.5 at Ashburton and potentially another 2.5 to 3 at Southwest Creek before we consider any other spending at Mount Marion or backfilling resources at Ashburton. So I guess it's a significant amount of capex, and I'm just curious, given your comments that you well and truly plan to fund, or how you plan to fund everything, perhaps you can enlighten us as to how much debt you expect to take on and when you expect net debt to peak. Thanks. And I've got one more.
So, Jack, hi, it's Mark. Thanks for the question. I mean, Chris was pretty clear in his statement that we've got a plan and we're going to release it progressively as we announce the full details on each of the projects. Historically, we've always been conservative with respect to debt. We've been prepared to go net debt for periods of time through expansion phases, but typically where we've got projects that will see the balance sheet return to strength pretty quickly. So we have a plan that will get us through the delivery of all those opportunities, but I'm not going to share the full details of it now, okay?
Okay, thanks. So you're not, I mean, can you say anything about whether equity is part of that plan, or whether this is more about selling down stakes in existing assets?
There's no plan to go and tap the equity markets.
Okay, thanks. And then, look, second question is just on the iron ore. Clearly a disappointing first half in terms of price realisations. Can you just tell us what you're assuming for price realisations for Ashburton, given its 57.5% product? And have you also adjusted your cost expectations at Ashburton in light of the increased transport costs in the half just gone? Thanks.
Look, I think firstly, in terms of controlling our costs at Ashburton, the transport costs there are very, very different. They are MRL owned off-highway units, so they're extremely low cost. They're fixed. There's a fixed capital cost associated with them. The diesel doesn't move the dial on that very much. So those costs, we kind of have them locked, and there's not a lot of variation on them. What was the second part? Price realisation on the material?
On the product.
Yeah, look, I think we've disclosed that in the past, have we?
I don't know if we've disclosed it, but what I would say, Jack, is that the project is very robust under any sort of assumptions you might want to make around price or discounts. So because of its proximity to the coast, because of the innovation that we're bringing through the crushing and the haulage and the transshipping, it allows us to be where we want to be from a cost perspective, and that gives us the resilience regardless of what happens on the revenue line.
I think the attraction to that project for us is that it's an extremely low cost per tonne FOB.
Yeah, absolutely. And look, one last sneaky one on Ashburton. Is there much more required to spend on that project to backfill resources, I guess, to meet that sort of 30-year life of mine? I know there's significant resources in the West Pilbara, but you're not necessarily 100% owner of those, so just curious whether there's a bit more spending required. Thanks.
No, what we've disclosed, that gets us, it gets us to that run rate for that period of time.
Okay, great. I'll pass it on. Thanks, guys.
Thank you. Your next question comes from Hayden Bairstow with Macquarie. Please go ahead.
Good morning, Chris and Mark. Just on the Marble JV potential changes, just keen to understand the metrics of how Kemerton will work with Greenbushes being fed into that. Will you have to pay market rates for that Greenbushes ore, or is there some sort of cost swap agreement likely to be in place on that front? And on the target of lithium hydroxide to 100,000 tonnes within sort of 5 years, is that some of these projects that Albemarle's talked about building in China already that will go into the Marble JV, or is this new stuff they haven't yet talked about either?
So on I don't want to talk too much about on the Albemarle side in China. They'll release the information as they see fit. They're in control of the hydroxide, the downstreaming, both at Kemerton and up in China. But what I can say is that we have got a very solid plan in house, and the reason for a few of the changes that we're moving around the deck chairs is that just trying to make sure that we've got an extremely solid joint venture the way it's operated and managed going forward, because this COVID thing has been extremely disruptive, so we've got to make sure that we've got the right people in the right places. We want to be able to guarantee production and that these plants and mines operate. So I think we've come up with a really sensible solution. There's probably a little bit more information flow to come out of this a little bit further down the track, and it'll make even more sense. So we haven't given all the information we can at this stage.
Okay, great. And on the iron ore side of things, just keen to understand, assuming you kick off Ashburton in earnest pretty soon, just on how can you move around people within the rest of the business? I mean, if we're not getting a lot of earnings out of Iron Valley, do you sort of repurpose people to focus more on getting Ashburton going and maybe down-rate production if we see iron ore prices come back again?
Yeah, look, certainly, Aidan, we've always done that. I mean, if we see iron ore or any of the commodity prices moving, we react quickly to make sure that we minimise any cash drain. And yeah, look, our focus is heavily on Ashburton, but at the same time, I mean, Iron Valley for a long, long time has always sort of produced, and it's had more lives than a cat, but it just keeps giving. So it's been a good mine, as has Wonmunna. We've got that online, but you know, no matter what way you cut it, they're high cost, small mines, but they got us to where we are with our balance sheet. They got our business to the size that it is. They do carry risk, but we're transitioning into these longer life mines, and they've given us the capital and the experience to be able to do what we're doing today. So as we grow as a business, you know, if you look back 10 years ago and 5 years ago and 2 years ago, we kept getting better and changing, and we're adding better product, we're adding better mines to our portfolio, and we've been able to carve out on these two iron ore mines, these two regions we're operating in. We've carved out something fairly serious out of that. And you know, to get a Cape-size carrier berth in Port Hedland, you know, it's a big berth, but it's in the biggest harbour in the world, and it's a machine to print cash, because it gives us that low cost. And then our partnership with Hancock is outstanding. I mean, we've got rail and port all of a sudden. You know, we're up there with the same supply chain as the majors have got. So you know, that's it's a pretty good deal.
Yeah, great, thanks. I'll leave it there.
Thank you. Your next question comes from Lyndon Fagan with JP Morgan. Please go ahead.
Thanks very much. The first question is on iron ore price realisations. So obviously getting around about half the iron ore price for the period, and realise there's provisional pricing impacts there. But I'm wondering if you're able to share a bit more detail about whether there's been a step up in impurities and how that rolls going forward, because I guess I'm just not feeling particularly confident about forecasting price realisations over the next few years, and I'm wondering if you can shed any light on whether we get back to where we were pre the half, or whether this is sort of the new norm, notwithstanding market discounts are wider. And then the second question was just to maybe talk a bit more about your plans for Port Hedland. So some pretty basic questions. The 20 million tonnes, can you maybe clarify whether that's your share or the entire scope of the operation, and whether Roy Hill was planning to ship anything else out of SP3 separate to your project, just to gauge what the capacity of SP3 could be? Thanks.
So the capacity, I'll talk about the first part of the second part of your question. So the capacity at SP3 should be around about 40 to 50 million tonnes. It's somewhere in that range, because it has B class allocation, and then beyond that there is what they call C class, so they're opportunistic tonnes. If you're efficient, you can get more tonnes out. The berth's going to be shared between Hancock and MinRes, so that's 50-50. And then we have another arrangement with them with the rail, so we've got a life of mine understanding on the rail, and we'll have of the tonnes coming down, they'll belong to the JV, to Brockman, and that'll be 50% they and 50% us on the price.
In terms of the realisations, Lyndon, it's Mark, sorry. In terms of the realisations, a couple of factors. First of all, in the appendix, there's a waterfall that helps give you some sort of indication of how those numbers have evolved. But from memory, I think it was something like 83% to 63% on a like-for-like basis in the half on a PCP basis. The prime driver for that has been market on widening of discounts, and you know, it's less about the impurities. There's been a bit of a move from the lump as the lump premium evaporated at one point through the quarter, and as we've tried to pivot our strategy to respond to the significant and fast-moving iron ore price. So, you know, I wouldn't think that I wouldn't, from your perspective, think of it in terms of impurities. That's not where the answer is. It's been more on the discounts, market movement.
Thanks for that. So just to clarify, the SP3 project is a 40 to 50 million tonne project of which you own 50% of, rather than it being a 20 million tonne project.
Correct. Yep.
Thanks very much.
Thank you. Your next question comes from Justin Raja with UBS. Please go ahead. Justin, your line is now live. Thank you. Your next question comes from Glenn Lawcock with Barrenjoey. Please go ahead.
Good morning, Chris. I just had two questions if I could. Firstly, just on Wodgina. Now that you've wrestled back control of Wodgina, just wondering, you know, firstly, how quickly can you ramp it up? What are the dollars required to, say, ramp it up? And given Albemarle still has the marketing, can you sell it to third parties, or is it only going to ramp up in line with internal consumption? So that's the first one, just trying to understand the Wodgina ramp-up potential, what you could deliver us. And then just on Port Hedland, just trying to clarify Lyndon's question. I mean, 40 to 50 doesn't really make sense to me. One berth, one shiploader is 30, joined up to Gina's Roy Hill project would add 60. So what are you assuming in the 40 to 50? Is that a joined up 3 berth, 2 shiploader configuration, or is it a standalone configuration, or is that still under discussion? Thanks.
No, so on the SP3, with one shiploader, Gina's got, on the Roy Hill berths, they've got 2 berths and one shiploader. This one will have its own dedicated shiploader, but what we're going to do is we'll be able to share all the shiploaders across the berths. It'll be run as an fully integrated facility with the Roy Hill existing berths 1 and 2. And the berth 3 is certainly capable of way more than 40 million tonnes. So it just comes down to the efficiency on how it operates. But we're not counting on more. We're not counting on more than that. We're counting on 20 million tonnes for our share.
Okay, but Chris, you'd agree that if you looked at FMG's configuration, they have 3 berths, 2 shiploaders, and they easily do 120. So it's conceivable that Roy Hill could go from 60 and double if you just take what's currently happening in Port Hedland.
Yeah, I think, trying to remember, I think FMG get about 185, 190 million tonne a year out.
Yeah, that's true, but initially they were 120 when they only had 3 berths and 2 shiploaders, which is what this configuration will be. So I'm just looking at a like for like, that was all.
Yep, look.
That's fine.
Yeah.
That's fine. And just the Wodgina ramp up and how much flex you have and the ability to sell third party things?
So Albemarle are responsible for all of the marketing. We think we're going to have first product on the ground in April. So, you know, we're nearly there. And there's no announcements made on sort of where the product's going. I mean, we're certainly going to have product going into downstream plants, and Albemarle is sort of working on securing those. So, I mean, when the time's right, we'll be able to come out and tell you exactly what those plans are, but I'm not sure that we really want to go and have our competitors understand exactly what we're doing.
Okay, but will you be selling outside of the JV or not, do you think? Or you can't answer that yet? Well,
look, they've just, Albemarle have just made a sale of some of the material. We've got quite a bit of material sitting up at Wodgina, and we're due to load a ship out of there shortly in the next week or 10 days. So we've got a cargo of spod going out to a third party.
I think, Glenn, it's Mark. I think the best way to answer that is to say the preference is obviously to convert wherever possible.
Okay, and could you give us any insight into the price? Will it be that miraculously high $3,500 spot price, or somewhere much lower?
There's two prices that sort of drift around. I mean, we have the other producers, we have long-term models that they basically go out and they use the carbonate and the hydroxide prices from around the world to come back and tell us what we think the market value of this product is. So we're all generally contracted in that way. The prices that you're seeing, those headline numbers, they are very tiny cargoes of spot price. So look, if I had to guess at the moment, I'd think that probably the contracted price probably sits somewhere between $2,000 and $2,400 US a tonne, and the spot market price they're quoting, which I don't know if anyone's got any tonnes to sell into that market. We haven't, and I don't think the others have, but that's about $3.25 US a tonne.
Okay, and I guess, Chris, just finally then, you work that backwards, you look at the spot chemical prices of $60,000 for carbonate, that would suggest they can pay $8,000 for spot or $6,000 for spot. What prices are you using on the chemical to work backwards then to get to $2,000 contract?
Look, honestly, quite honestly, I mean, the price has moved quicker than our spreadsheet. So, you know, in the last 3 months, the price has just gone from something that we thought was getting out there and we're very happy with, but it's probably doubled. So we're just not doing a lot on that at the moment. I mean, we're reasonably comfortable. All the numbers that we done some years ago do exist somewhere in there. I remember when it last got up to about 1,300 a tonne and we were extremely happy with that. Then it was down below 400. So look, we're not doing a lot of work around that. We're just confident that all of the base numbers that we built Wodgina on and all the numbers we've put the JV together on do exist. But you know, we've all seen commodities that go up like skyrockets. I mean, there's probably only one way for them to go eventually, but I don't think this is going to have a crash landing. I think that there's clearly out there since COVID come along. I mean, a couple of years ago, there was a handful of car companies making electric cars. Today, if you're not making an electric car, you're not going to be in business. So I think the supply-demand chain is very different to what we've seen. And I don't think there's any doubt that year on year for the next 3, 4, 5 years out, the demand for lithium is going to continue to grow. I mean, you read that if it gets too high, they'll go and try and find an alternate fuel. Well, it's taken them probably 30 years to get to where they have with lithium. And I don't think that, you know, even if lithium's selling at $3,000 a tonne for the spod, it doesn't move the dial that much on the end cost of an electric car. So look, I don't know, I really don't know. I haven't seen a market like this before move this quick.
All right, that's great. Thanks for the colour, Chris.
Thank you. Your next question comes from Peter Kerr with the Australian Financial Review. Please go ahead.
Hi, Chris. Thanks for your time. Just on that same topic, you know, the last 7 years in spot prices, we saw big ups and big downs. You know, we hear you wanting to do more out of Mount Marion, bringing back what, you know, Ken Brinston ramping up output. So are you thinking about this period differently to make sure 18 months from now we don't have a sharply falling price? Are you going to be a bit more conservative than last time? And secondly, is there a time in the future where the spot price becomes irrelevant for you and the hydroxide price is the most relevant thing?
So first on supply, we're starting train 1 at Wodgina, and we're going to do a watch and see what happens with the market. So we have the capability of turning on 3 trains up there. We're not doing that. We're just going to take this slowly and make sure that we get it ramped up properly. The most relevant for us, I think, long term, and I've always thought this, if you own the rock in the ground, then you own and control your future. We want to get the value out of downstreaming, so our aim is to get all of our rock converted to hydroxide as soon as we possibly can. We've got a plan at the moment, but I think that we'll be able to refine that going forward. A lot's happened in the last 12 months, and we're still playing catch up with our joint venture partners because of the uncertainty that's been sitting out there. But look, I think there's no doubt down the track, I mean, we're going to have a substantial lithium business. We have one right now, and we probably have the most clearest certain path of any of the lithium producers I know of to get to where we want to, because we have 2 operating mines, we have the rock in the ground and a lot of it. We're in the right jurisdiction where we're probably going to have least disruption, and we've probably got the 2 best hydroxide operators in the world with Ganfeng and Albemarle. So, and we are going to build those plants, and we're going to do it as quick as we can. So, yeah, it's going to be a very big part of our business going forward.
And the reference today to building plants outside Australia with Albemarle, can you name the continent where that's most likely to be? Is that Europe, North America, Asia?
Quite honestly, I mean, there'll be some in Asia. There's no doubt about that, but there's still through their marketing arm, they're still trying to understand where the best places are to put them for the future.
Beauty. Thank you.
Thank you. We will now move to the webcast questions before coming back to the questions on the phone. Your first online question comes from Praveen Mani, who asks, could you talk about the use of the offtake from Mount Marion after the tolling agreement with Ganfeng ends?
Yeah, sure. So you'll notice in there that we do have the right to extend with Ganfeng through mutual agreement. And I think they'll be keen to, but look, our first priority again is being able to make sure that we change that part of their business. We wanted to get that offtake back, and then we wanted to get that that agreement in place with Ganfeng. That's a starter, and it just gives us some time to breathe, because we've had so many different projects and things on our plate over the last 6 months, and to be able to cover off on all of these take a lot of effort and time to be able to get the right agreements in place and get the planning done. But that's basically an interim agreement that'll give us some breathing time so that we can work out whether we can extend that with them. Pretty sure we can. They've said they'd like to, but that's as far as we've got so far.
Thank you. Now moving back to the phone questions. Your next phone question comes from Alex Wren with Credit Suisse. Please go ahead.
Hi, Chris and Mike. Good morning. 2 from me, please. I guess both still on lithium pricings. So many of your lithium peers have provided forward-looking price guidance. So could you give us some more color on that? And it looks like what Ming realised currently is towards the low end when comparing to peers. And with the new toll treatment agreement at Mount Marion, how will the pricing mechanism work? Does that mean we'll see, I guess, much more upside on spodumene price realisation, say trending towards maybe spot, maybe the $2,400 contract price that you just quoted? I'll revert back on the second one. Thanks.
So let me try and understand that the pricing for what we're doing out of Mount Marion. So all of the lithium, all of the spodumene that goes out of Australia, it has to be sold at market value, whatever that value is. So that's where it's a little confusing at the moment. I had a discussion some time ago with the mines department on how any of us understand exactly what market value is, but we have that model, that formula that we've used for the last 4 or 5 years. So that product goes from the Mount Marion mine, which we call the RIM JV, and it goes 49% to Ganfeng, 51% to us, and then when it goes offshore, it simply gets converted. And we have a model over with Ganfeng, and we understand what the costs on that are. What was the other part of your question?
He's looking for guidance on price outlook, I think, if I heard the question correctly, Alex. I think Alex was on lithium.
On lithium or hydroxide?
On lithium generally, I think was the question.
I wouldn't mind going back to you guys and getting it.
I think... Alex, it's Mark. If I could just add to Chris's to answer, with Ganfeng, we've got a wonderful partner. We've worked very closely with them for a number of years, and we'll work with them on the best structures from from a tax and funding perspective to get the right outcome for the business. In terms of the price guidance, we're not in the habit of trying to guide on price. In fact, we focus all of our numbers looking forward on volumes rather than price. So we leave it to the market, and you guys obviously understand the challenges, particularly in the lithium space at the moment.
Understood. I guess so. The second question is a follow-up on Glenn's question regarding the pricing structure at Wodgina with Albemarle. At least for the internal consumption part, are you engaging with, I guess, the ATO on the potential risks around transfer pricing? At least looking at the current market dynamics, most of the margins would be flowing to downstream offshore, hence, I guess, potentially running into troubles with the ATO.
We are. We are concerned with that. We're very transparent with our concerns around that. But look, at the end of the day, we continue to manage and use the same models we've always used, and there is no gain. MinRes is 100% Australian. There's no gain in us trying to lessen the price that we put spodumene offshore for, because eventually it gets converted offshore, it gets sold offshore, but all of the money that we make out of that comes back into Australia. So, we pay the tax. So it's not like we can escape it. We don't have an offshore arm to the business.
Thank you. Your next question comes from Stuart McKinnon with the West Australian. Please go ahead.
Oh, g'day, Chris and Mark. This question's probably directed at Chris. Just in relation to the borders reopening, obviously there's been a lot of talk in WA around this issue, and as you'd be aware, the Premier announced a few weeks ago that February 5 wouldn't go ahead. The opening on February 5 wouldn't go ahead. Are you at the stage, Chris, where you believe that it's time to set a date for the WA border to reopen, or are you quite comfortable with the current settings around that?
No, look, quite honestly, I think that I've always been very comfortable the way the McGowan government's managed us through this COVID. I think a lot of people would love to go on holiday or go out east or the like, but my focus here in the business is to make sure that we keep all our people fit and healthy and keep them employed so that they can keep earning money to take home and pay for their mortgage and their kids' education. So our priority has been trying to keep the mines open, and I think when he made the call to keep them shut to extend the hard borders, I think was a great call, because we were probably going to have in the order of, I think, 20,000 plus people a week coming into the borders. So they're going to bring COVID straight in, and everyone was saying, well, what happens to all the small business? Well, they keep operating the way they are now. If COVID come in and we just let it rip, as they'd say out east, I think it would have shut a lot of businesses, and people would be doing what they're doing out east. They'd self-isolate. I'm very comfortable doing following the lead that Mark McGowan's following, because if we just let the people trickle in and try and keep the curve down, we've got a chance that we might be able to get through this without getting brutalised.
Okay, thanks, Chris.
Thank you. Your next question comes from Lachlan Shaw with UBS. Please go ahead.
Yeah, hi. Thanks, Chris, for the update. A couple of questions here. So just firstly, on the iron ore business, just interested to understand what the strategy is to bring the upstream assets back into profitability, and also just what's happening with current realisations as well, given that we're seeing benchmark 62% around $150 a tonne.
So, hi Lachlan, it's Mark here. In terms of the realisations, we don't expect them to, we don't expect the discounts to widen. They've come in a touch, but we don't expect them to widen. In terms of bringing them back to profitability, as I said in my comments, slightly under half of the loss was referable to a prior period adjustment, and a big chunk of the cost impact sat outside the mine gate. So, shipping costs impact 151 million PCP is going to change with the shipping market, and we're seeing signs of that already. In terms of the offsite haulage, that was a $54 million impact on a PCP basis. That's primarily driven by access to hauliers to transport the product through COVID. We've basically had to pay more to get the tonnes moved. So you can expect those numbers to come back, particularly on the haulage, as we start to get a little bit more flexibility into the supply chain. So turning it around, it's less of an issue around costs at the mine gate or inside at the operations. There has been some impact there, but not enough to really drive, the profitability or otherwise.
Got it. And so just to follow up with the iron ore business, so Ashburton, are you still looking to take FID on that mid-year? And just where does that fit in respect of the government approval process? Have you got all the approvals lined up, or when are they coming through?
So we've got majority of the approvals through. In terms, the big one was in around the port. We've still got some detail that we're working through on that, but the major approvals are done. And then most of the access we need from port right through to mine site, we've got that, almost all of that in hand. There's some other stuff in there that'll happen progressively, but we don't need it to happen before the project starts, if that makes sense. So all of that's sort of gone pretty well. We've also got the benefit now that we've entered into the Red Hill JV with API. We got the benefit of a lot of the other approvals and arrangements and agreements they had in place. So we we inherit those.
Got it, thank you. And then look, just second question on the lithium business. So just with Mount Marion, obviously 4% was, close to half production in the December half. How should we think about the split between 5.5% and 4% spodumene for the rest of the financial year? And then secondly, in terms of the expansion that you're looking at Mount Marion, again, how should we think about modelling, 5.5% versus 4%? Thank you.
I think for the rest of this financial year, it's not going to change a whole lot to what's happened. It'll probably sit around that. Look, in terms of the two studies that we're doing up there right at the moment, do nothing at the moment. As soon as we get through those, we'll make a decision. We'll get that announcement out and we'll tell you exactly what that means to extra product on the ground. And if we're going to do that, we'll obviously change our guidance straight away.
Thank you.
Thank you. Your next question comes from Rahul Anand with Morgan Stanley, Australia. Please go ahead.
Oh, hi, Chris and Mark. Hope you guys are well. Two from me. Look, you have addressed a few questions already, but firstly on the mining services 5-year guidance, you've got 50 to 20% CAGR over the next 5 years. I just wanted to understand, is this tonnage guidance? Is this revenue guidance? Is this EBITDA guidance? I guess I'm trying to understand whether the construction revenues that you'll get, which are very, very low margin, are part of that guidance for the 15 to 20%.
We will always try and give guidance in tonnes. We're not in the habit of doing it around EBITDA, but so that all the guidance there is based on tonnes.
And just further,
so that would exclude the construction.
Sorry, Rahul, it's Mark. I was just going to add on the construction piece. We don't run the construction business as an external sort of profit generator. And over the next 5 years, that team or those teams are going to be very much focused on internal delivery.
Okay, so just one follow-up there, Mark, if I may. I noticed that in the last full year results, you had about 30% of contracts in terms of revenue coming up for a renewal. over the next 5 years. That number seems to have risen to about 65 in the mining services revenue. Were there a fair few contracts that were sitting on the cusp? And can you provide a bit more colour as to what contracts are these, internal, external, and how should we think about that revenue longevity?
So, Raoul, I think the best way to think about it is, we can point to a track record of retention over the last 15, 16 years as a listed company, probably unparalleled. So we've had a 100% retention rate through this half, and it's basically because of the relationships we have with the customers and the way that we go to work with them. So, I think in terms of trying to get a better flavour for the book and what it looks like going forward, I'd be thinking more in terms of the growth opportunities. The market needs players, us, who can respond with agility and in ways that sometimes difficult for others, right? So we see a lot of opportunity going forward. We've got a great track record in terms of retention that we can point to. We don't expect that to change.
Perfect. No, that's fair. Okay, second question was on Mount Marion. Chris, you talked about two projects. One's the ultrafines and one's the basalt. Basalt's pretty straightforward. With the ultrafines, I wanted to understand, are you aiming to basically have better blasting so that your fragment sizes are bigger and the yield goes up in the plant? Or are we talking about a significant CapEx item in any way here for Mount Marion? And then also the timing. How should we think about when this extra production can come in?
Okay, so on the timing, we're thinking that we're going to have it sort of finalised so that we can approve it, and that is getting the test results back. But we're thinking that maybe around August, September, we might be able to have that in place. And in terms of CapEx, it's fairly minimal. It's a lot to do simply around changing some gear out down there for some other gear that we've got. Cone crushers will be going in, and it's just basically giving the rock a lighter touch. Nothing to do with the blasting. It's all in the plant. It's giving the rock a much lighter touch and trying to minimise the ultrafines generation, because once it gets into the ultrafines, it's fairly hard to recover the lithium units.
Perfect, that makes sense. Can I sneak in one more on Marillana, if that's okay, please? That just relates to the production grade. You've talked about that in the presentation today, 60.5%. That's obviously a bit higher than the resource grade, and I understand there might be some beneficiation there. Is it simple wet beneficiation similar to Fortescue, or are you looking at something different here?
No, it's pretty simple, basic wet beneficiation. So that deposit up there is sort of, there's no real drill and blast in it. It's pretty much the whole deposit's free dig back into the back of a truck. So the in-pit part of it is fairly low cost. Then it goes into, there's probably about between 10 and 15% that needs a light crush. And then it's straight into the Benny plant, and it separates and the waste goes out and the product in the other stream.
Gotcha, okay. That's very helpful. Thank you both. I'll pass on.
Thank you. Your next question comes from Paul Young with Goldman Sachs. Please go ahead.
Morning, Chris, and good morning, Mark. Hope you're well. First question is on the crushing contracts. Note that you had a pretty decent step up in external revenue, PCP, and you took on those 4 new contracts. Chris, what commodities were they, if you can help us? And also, were they all crushing contracts, or were there some of those mining contracts?
No, look, there's a mixture in there of crushing and mining. We've got a very specialised mining division, and we're able to secure high quality mining equipment, and have been able to over the last few years where others can't. But look, it's a combination of mining and crushing, and we're heavily into the iron ore area. Obviously, the equipment we run can deal with that. We've got really good experience in that area. But there is also, look, we recently, one of the contracts we just won recently was a little one up in the Territory crushing some spodumene. But so it's a mix. There's a bit out there in the gold industry. We tend to only be able to work for the bigger gold companies because of the safety regime that we and they run. But it's a bit of a mix, and I mean, we kind of know where a lot of our clients are headed over the next 3 years at least. We get some good consultation with that. But there's also the element of surprise. Things come out of the blue where they need our services. We carry a huge amount. We have several $100 million worth of crushing and processing equipment that we keep in stock.
Okay, thanks, Chris. And then a question on CapEx and the guidance increasing by 100 million. Obviously, everyone's wearing inflation at the moment, particularly in WA. Can I actually ask a question around the Ashburton 2.4 to 2.55 billion capital estimate? And that estimate's probably a rapid inflation estimate. Are you still comfortable? How robust is that estimate?
Yeah, no, it's a pretty tough number. Just bearing in mind there's no real technology in this project. There's no black boxes in it. I mean, we've got to build a road, we've got to build a port. I mean, all of that's fairly straightforward. The port that we're building, it's a very shallow berth. I mean, the transshippers draw about 6.5 metres of water when they're fully laden. So not a big deal on that. The storage, we do everything is undercover on Ashburton, so it's a completely dust-free environment all the way from the mine through to the ship. But I mean, probably our biggest risk on that was the transshippers. These transshippers are a first in the world. They've been designed in-house using international marine consultants. They would be our biggest risk on the project, but we've just let the first two, and we got down to the number we're looking for, and we've got them in one of the big shipyards. So I think we've pretty much got it covered. You know, we're building sheds, we're opening up pits, building a road. The road, if you're going to build a road, I mean, that's the place to build it. I mean, you can almost see the mine site 150 k's out, so it's pretty flat.
Great, Chris. Final question, still on the CapEx theme, and looking at the Hancock joint venture, when will you have a capital estimate for, on a 100% basis and therefore your share? And it seems to me that's a lower risk project because it's rail versus road versus Ashburton. How do you compare the IRR versus the two and the risk profile?
Oh, look, the risk is obvious. I consider the risk at Ashburton extremely low. I mean, what we've built, I'm going to say we've probably built 400 or 500 k's of road ourselves in the last 5 or 7 years. So we know what we're doing with that. We've got a big bridge to build over the highway, but we've got main roads that are going to build it for us, and we've got a number off them. Building out in with Hancock's on the Roy Hill line, I mean, that's a fairly safe operation. We're going to put another berth in the harbour, and that's been done about 17 or 18 times before. We're going to add to an existing rail. We're going to add to an existing stockpile. So, it's all fairly low risk, manageable in terms of the capital. And we're expecting FID to be June this year. So Hancock have got a fairly big team working through right now on getting all those numbers pulled together. We'll have them over the next couple of months, and I expect FID will be about mid-June.
Okay, that's great. And then maybe just a follow-up, maybe it's for Mark around the IRR. Mark, how do you think about the returns of Ashburton versus Port Hedland?
I'm excited by them. Is that a good answer? They're both robust projects. They both offer us mining services opportunities with long life. Marillana's obviously different grade to Ashburton, so they're in different parts of the market. But I don't have a preferred child if you're asking that question. But come back to what I said earlier. Each project we look at's got to be able to deliver at least 20+% return on invested capital after tax, and that's not assuming $100 or $110. That's assuming sort of long-term guidance prices given out by guys like you. So both of them are robust, and I think I'd be excited to have either in the portfolio, let alone both.
Yeah, thanks. I know at the tail of the questions, guys, but just one last one, Chris, just on FID in June. Looking at your presentation, you say it's 2 years of approvals on the Pilbara Hub. Is the FID around the port as opposed to the mines?
It's as a project as a whole. We can't have the mine if we haven't got the rail or the berth. So the whole thing's a package deal. We've got to make sure they all line up. We've got to make sure that the cost of the dredging is what we think it is. So we've just got to make sure we lock all those numbers down, and then we relook at the project and make sure we're going to get what we want out of it. Just a little bit more on that question you were talking with Mark on the difference between the two projects is that they've each got some good and bad in them. So if you compare costs are going to be a little more elevated on the Marillana JV as compared to the Ashburton one, because we're moving a lot of tonnes there. Because we beneficiate, we move a lot of tonnes and send some waste back. We have to still road haul probably 100 k's down to the rail head, and then once it goes on the rail, we get it down for a fairly low number and into a ship. When we pick it up in the Ashburton, we're only 150 k's out as opposed to 300 out. And those big trucks that we operate, the cost per tonne kilometre on them is comparable to the trains that we're running in the Yilgarn. So, they've all got their pluses and minuses, but if ore gets down to, if it's 40 US a tonne, we're still operating and we're still banking cash.
Okay, thanks Chris, thanks Mark. That's it from me.
Thank you. A reminder to please limit yourself to 2 questions at a time. Your next question comes from Paul McTaggart with Citigroup. Please go ahead.
Hi gents. Look, I just want to follow up on the agreement with Ganfeng around tolling. So obviously you're doing that because you're trying to pick up a bit of that margin, the hydroxide margin. So can you give us a sense of, in terms of a kind of realised price for spodumene for you, how that might change as you go to a tolling agreement? Because obviously we've kind of put some tolling costs into our numbers, at least for the 7 months.
What I said earlier was that with Ganfeng we've got a great partner. We'll work through the structuring. One version is that we're just selling at market price as we currently are, and that picks up Chris's point around the whole transfer pricing issue. At the other extreme, we effectively do it on consignment. I'd say that's less likely, right? So we're just working through, and part of the consideration is tax optimisation. So, not that I'm allowed to say that, but that's one of the things we have to think about. So I think think about it this way. The best way to think about it, simplest way to think about it, is we continue to sell the spot at market, and then we take a clip on the hydroxide down the track.
Okay, thanks.
Just if I could stress a bit more, the commodities, iron or whatever they are, always have to go onto a ship at market price, because there's 2 things. One is that the state government need the right amount of royalty, and that's got to be very transparent, so we're very careful with that. We stay in touch with the state government on that. And then secondly, whether we sell the spod for $1 a tonne going out of the country, we still own it when it goes out. It gets converted as hydroxide, and regardless of where we make the profit, all of our money comes back into Australia, and we pay the full amount of tax. So there is no advantage in trying to even do any price transfer. Not that we would, but there is no advantage. The tax department, I think, are very relaxed with us, because no matter what happens, they pick it up.
Thank you. Your final question today comes from Robert Stein with CLSA. Please go ahead.
Hi guys, just a quick one on short-term pickup in iron ore pricing and the recent news out of China relating to pollution restrictions being unwound or deferred. Are you seeing a change in procurement practices by the mills that you're selling ore to and an increased demand for lower grade ore? And the second question I have is a longer term one around Brockman, but I can come back to it.
Look, it's hard to get any real transparency at the moment through to in terms of the ore, but look, certainly there's always a very strong demand out there for the lower grade ore. I think when they get it into the mill and they do their blending, I think they obviously enhance their bottom line using low grade. But I mean, we don't get much visibility over what's been happening in there over the last 3 or 4 months.
Cool, thank you. And then just on a longer term question around strategy around Brockman. So with the FE grades and the announced intention to share infrastructure through Roy Hill, is there any sort of opportunity for blending and optimisation of grades across both mines as you enter into that relationship? Is that part of the current sort of field of agreement that you're trying to drive with Gina? Yeah.
Look, I would think probably not. A lot of the time, there's no real value in blending the ore, because if you're blending a good grade ore with a poor grade ore, you know, you almost end up where 2 and 2 equals 1 and 7/8. So the cost of doing it to start with is difficult, and then if there's different ownership, that becomes difficult. So there's not very often a value add in it. A number of companies they do have blending yards in China, like Rio Tinto have got one over in China, and I think FMG have got them. So in certain instances, they find value in doing it that way, but not. I don't think there's any for us, and certainly not. I don't think we'll be blending Onslow with Marillana. That's almost a certain that wouldn't happen. And I don't think sorry.
Oh, no, sorry. Even with the CID ore that forms part of the Brockman reserves? Or are we just thinking of that as discrete products with discrete realised pricing?
Yeah, look, I think we'd want discrete products, and what we've looked at so far, I mean, our experience tells us that it's a better outcome for us financially.
Perfect. Thank you very much.
Thank you. That's all the time we have for our question and answer session today. I'll now hand back to Chris Ellison for closing remarks. Okay, well look, thanks everyone for joining. I think we had some good questions. We've given as much information as we can. We will have more news flow certainly over the next 3 and 4 months, and as that comes available, we'll make sure we get that out into the market straight away. And as these projects get to start up, we'll certainly be all over the funding. So I don't want to say just trust us, but our track record kind of suggests that we're more than capable of delivering what we commit to, and it'll all become clear, I think, over the next 3 months of exactly how we intend to put all that funding together. So don't stress over it. We'll give you a roadmap on exactly how that's going to work as we go forward. You'll have plenty of time on that. So look, thanks everyone for joining. Thanks for everyone behind the scenes and helping me pull this together. It's been a great job from our team as always. And we will talk again probably in about 6 months from now. Thank you.